very excited to be here today. For those of you who don't know me, I'm Marguerite Crespillo, and this is our Tuesday Tuneups. Every week we do this every Tuesday at 9 a.m. And it's always free content available to help you build and grow your business in a changing market. You can stay up to date by going to margueritecrespillo.com and adding your name and email to my list to get regular updates of upcoming topics and guests and things like that. I teach a lot of them, but I'm having more fun getting amazing guests on the show. And so let's dive in because it's 9 o'clock and I want to be respectful of everybody's time. So today I'm really excited because, oh, my hair's doing some wacky thing there, huh? Like going, it's today I have my good friend Liz Anderson on the show. I've known Liz for many, many, many years. And the irony of it is I didn't really understand a whole lot. I still really don't understand a whole lot about how reverse mortgages work. But, you know, as you get older, you start to pay a little more attention, and I'm actually of age now. So I think technically get a reverse mortgage. So now I'm starting to pay a little more attention to how things work. But what was interesting that I heard the other day is that we're located here in the Sacramento region, but we have guests and we have people from all over the country. And the interesting thing is that I was talking to Ryan Lundquist, Ryan Seacrest, that'd be funny. Ryan
He's
Lundquist.
a celebrity.
Yeah, he was hanging out with me. Ryan Lundquist is almost as big a celebrity in our market. But,
Yeah.
And he was saying that the majority of buyers right now are actually buying in the over 55 communities. And there's some really great ones here coming up in my particular area. I live in Lincoln. And we just had one open up called Esplanade. And then there's another one going in across the street in Bigford Ranch. So it's becoming a big thing, right? Us boomers have like got to find these party places to live. So we're going to dive in. Liz is here and she has Des. Do you say Lenz? Is that how you say your last name, Des?
Yep, that's
Okay.
perfect.
Perfect. So I'm going to also, because I think you have some slides to share, right?
Yes.
So I am going to also make you a co-host so that you can share your slides. And so I'm going to also change the view so we can see you. So there you go. So Liz, do you want to say anything to introduce them or?
Nope, I'll dive right in and tell you a little bit about us. And then if you're okay with that, then I'll dive in with some of the things that you need to know to recognize opportunities in this market. And then I'll let Des take over with the surface and share the screen so he can share you examples of live transactions that we've done. And it all is going to be based off of mostly the reverse for purchase, which is what realtors really want to know, because if you're talking about these places that are opening up that are super cool, that I also just noticed, by the way, I'm like, wow, I want to live there now. They're really, they're awesome. So we want to share with you how to grow your sales, especially in markets like this. So with that, I'm just going to go ahead and get it started. And for those of you that don't know me, my name is Liz Anderson, and we are with American Pacific Reverse Mortgage Group. And I have been with Des and American Pacific Reverse Mortgage. I can't even believe it. I'm going to be going on my 15th year now, which is crazy.
Yeah, it is crazy.
I got into this industry, believe it or not, in a market not so much like this, thankfully, but in the down market in 2008 when things were falling apart, and I knew nothing about reverse, and I honestly was looking at it as a stepping stone. And here I am almost 15 years later, enjoying what I do and working with realtors and educating. And so today we're going to teach you a little bit about, I'm going to teach you or tell you a little bit about guideline, what you need to know to recognize, things of that nature. And then Des is going to share with you those examples. So with that, let's get started. For those that don't know, reverse mortgage is also called a HECM, a home equity conversion mortgage. So when you hear that word, it is the same thing as our industry known reverse mortgage, the FHA product, which is what we're going to talk about more so today. And what it is, it's a loan that allows a homeowner to borrow the equity in their home. The purpose is always the goal without having any principal and interest payments, as long as they live in the home, could be forever. So you do a reverse mortgage, you don't have a principal and interest payment moving forward, but you will have to continue to pay property taxes, homeowners insurance on time, maintain the home in normal condition as you would any other home. And then last but not least, it has to be your owner occupied property. So you can't do a reverse mortgage, move out, rent it. Now you can have somebody come in and rent a room after you do a reverse mortgage. That's allowable, but somebody, whoever's on the loan, whoever's on title, has to live in the home as their primary residence. So that's the first thing. They could do a refinance, stay in the home if they need to. The other way it can be used is to purchase a home without having any principal and interest payment. So we're going to talk about that. We're going to dive into that mostly so that you guys can recognize that. So continuing on, I have my handy dandy notes over here just in case. So some of the obstacles and some of the things that we run into right off the bat, particularly, I'm going to say not only with clients, but also we have heirs that are involved. We like to make sure that anybody who would like to be part of the process knows what's going on behalf of their family members, loved ones. So the first thing we hear all the time is, I don't want to do that loan because that's the loan where the bank owns my home. The bank does not own the home. Whoever is on loan is on title. And if anybody wanted to, if the owner wants to sell that home 5 years after they do a reverse mortgage, they can do so without penalty. So it is your home to do what you want with. The other thing is that the client maintains ownership. We lend directly to a trust. We actually prefer it that way. So if there's a trust in place, we ask that we review the trust ahead of time, make sure that it's a correct trust and it follows the guidelines. So we lend directly to the trust. The other thing is the borrower cannot outlive the loan. So it is an FHA loan. It is insured. There is mortgage insurance associated with this loan, just like an FHA first-time home buyer. There's FHA mortgage insurance associated with that. So people will say, I don't want to pay that upfront mortgage premium because I don't want that insurance. Well, there's a few reasons that this insurance is in place, and this is really important. So it's in place for 3 reasons. If in case a borrower lives longer than they're expected to live, because this is an age-driven loan. If they live longer than their age tables predict, and let's just say at that point in time, the market's tanked, how it was in 2007, 8, and values have plummeted. And the last borrower vacates the home, and let's just say the value is down here and the balance of the loan is up here. There's going to be a shortfall. It's going to be a short sale. Well, what happens at that point in time is that that FHA premium and the insurance premium comes in and pays the loss to the lender, to the bank. So they are made whole. The other thing that it does is it protects the heirs, because a long time ago, the reason this myth is around is because if somebody had a reverse mortgage and the parents, let's say, passed away, they would come after the heirs for that difference, for that shortage. So it now protects the heirs. And last but not least, it protects the estate. So if the borrowers had an investment property, if they have assets in a portfolio with an advisor, if they have money in the bank, nothing else gets attached to this loan. The home is the sole security for the loan. So that's what FHA insurance is there for. Not in case you default on a payment because there is no payment, but because of all of those things I just talked about. So if you have a borrower that maybe wants to stay in the home instead of selling and buying, and they can access funds and maybe get a monthly payment, those proceeds are all tax-free. So they're not considered earned income. You don't receive a 1099 at the end of the year. So all proceeds from a reverse mortgage is tax-free. Doesn't affect Social Security or Medicare. Medicaid and Medi-Cal. We ask that they ask those entities to see if there's going to be a default to that benefit. So make sure that that is also taken care of. Borrowers are never forced to leave the home. There's an asterisk that we put on that little comment because you have to follow the 4 rules I mentioned. Property taxes, homeowners insurance, pay those on time, owner occupied, and proper maintenance of the home. You continue to do those things, you live in that home, even if the balance goes upside down, nothing changes, but those are the rules of the loan. So we talked about debt doesn't pass to the heirs. And there is one piece of this, just like a traditional first-time home buyer. If a borrower wants to move forward with a reverse mortgage, all the numbers work out, they're happy to do this. Before they move forward with application, appraisal, and starting the process, they must complete HUD-approved counseling. So they do the counseling. We here in California, we have to wait 7 calendar days before we can move forward with an application. It's called the cooling off period. So let's talk about some of the requirements. On the FHA, you have to, you have to be 62 years or older. It's going to touch on the programs that are 55 years and older because that is something that has been fairly new to our industry. It must be the primary residence. On purchase, all down payments and closing costs, including gifted funds, must be documented just like any other loan. This is something different in our market. There are no builder incentives allowed, no credits allowed. Now, I know that our market is like a light switch right now. It's like hot, it's cold, it's turning on and off. Some months it's busy, a month it's busy, 2 weeks later it's dead. So I know that builders were working with giving credits and all of that good stuff. It's not allowed on a purchase. And also no seller carrybacks. They must meet credit and income requirements. When I first started this industry, we could do a reverse mortgage for anybody that had any kind of credit. So if their credit score was 405, we're like, okay, what's your income? We can do this. It's no longer that way. You do have to income and credit qualify. It is easier to qualify for a reverse mortgage than it is for traditional financing because we're not ratio driven. So what we do is we take all of their income. So let's just say it's just Social Security. We have a lot of clients that we can qualify that have very low debt that qualify for a reverse mortgage. So we take their Social Security, we run a credit report, we deduct all of their minimum payments on their credit report, we deduct their property taxes, their homeowner's insurance, 14 cents per square foot.
Sorry, I'll mute some people.
It's okay. 14 cents per square foot of the home for utilities, and any other property like H. If one person lives in the home out here in California and they may have $589 left over after we make all of those deductions, they qualify. Now, that is on income. Credit, we want to make sure we're not FICO driven. So we're not looking at credit score. We are looking at the last 24 months of payment history on credit report and also on property taxes and homeowners insurance. So if all of that looks good, then we're ready to roll. And last but not least, all judgments and liens must be paid off with the proceeds of a reverse mortgage if there are any when people are trying to stay in their home. Almost done here on the guidelines. So acceptable property types: single family residence, 2 to 4 unit dwellings, condos that meet FHA guidelines, even manufactured homes that meet FHA guidelines, but they must be on owned land. They cannot be on rented space, and PUDs, which we have here in our area as well. So how does the reverse for purchase work? Here's where it comes in for you all. So the reverse purchase, the way that the loan amount is calculated is that we take the age of the youngest borrower on the loan and we take the value of the home and we plug in the current interest rates. It's going to give us a loan amount available to that borrower. So I'm going to give you a quick example. If we have somebody who's, let's just say, age 72, they're looking for a $600,000 home. We plug in all those three things I just mentioned into the software. We're going to get a loan amount of $265,000. The sales price was $600,000. They're going to come in with that difference. It's going to be $335,000 as they're down, and they're left with no principal and interest payments moving forward. So it's sales price minus loan amount equals down payment, to simplify it for you. And a lot of people will say, well, that's a really huge down payment. We're talking about a different demographic of borrowers here. People that are of this age have the most equity in the nation. So they're usually taking a scenario where they have a big house and they're ready to move into a smaller home. Too much dispensable space. There's 2 stories, just too much house for them. So they're taking the equity from one home and moving it into another. So I'm going to share with you just a couple of scenarios that Des is going to share with you. The purchase, you can downsize, you can right size, you can actually upsize, like Margarita was talking about. I think that anybody that might want to be moving into these like new luxury facilities that are coming up, I think that's going to be an upsize scenario based off of everything that you're going to have there. I don't think it's going to be very cheap to move there. So that might be an upsize. And
Yeah, they have
we
bars and pickleball, and they have
Yes.
pools with concierge. It's amazing. Like, that's
Yes,
what
it's going to be cool.
my
So I
friends
think,
moved
like I
in there.
said,
They love it. Yeah.
yeah, I think it's going to be an upside scenario. So this might be a perfect way to get your clients in your database that you maybe haven't thought of that are thinking about going there, but they don't know how. This could be your tool to get there. So relocating to closer to family members, whether that's in or out of the state, as we have seen in the last few years, relocating to closer medical facilities. And believe it or not, I actually have one going on right now, divorce situations. In our industry, we call it silver separation. So there are uses. I'm going to let Des take over the screen now, and he's going to share with you the examples, some real life things that we've been able to accomplish. And they're outside of the box. You're going to be like, I didn't know I could do this with this. So Des, want to take it over?
Thank you,
Sure.
Liz. That was amazing. I can't wait to hear the rest.
Got it.
Marguerite, how much time do we have, just so I can honor people's time?
Probably another 20 to 30 minutes. So we have
We're in
plenty
good
of time.
shape
We
then.
usually run it from 9 to 10. So yeah.
Sounds good. Can you see this?
Yes.
So what we found out over time was this reverse mortgage is a financial tool, much like that Leatherman. There's a lot of things you can do with it. It's pliers, it's screwdrivers, it's a knife, it's all those different things. And we're going to illustrate some of that for you. And the one thing I do want to point out is, like, if you have any questions, you're going to reach out to Liz, and she can help you with scenarios and other things that might be necessary to follow up on. So, and what I'm finding out, my screen is not sharing. So hang on a second.
It was.
It's sharing, but it's not moving. So let's see here. Hang tight. You're gonna, Marguerite, you can do an advertisement or something while I figure this out,
I'll do
okay?
a little dance over here. Or
Please
something,
do.
right? Like-
Please do.
No, I just think that it is really interesting because I never really thought about this program, and I definitely didn't think about it in the purchase scenario. And I've actually had a few clients call me with, issues on their reverse mortgages. And what I love is that Liz has always been available and ready to answer those questions and help, because, sometimes people get into these and they don't really completely understand it. And so, what I love about Liz is that she's able to help us explain to our clients what's going on. So we did have a quick question. Alicia asked, hang on a second. What happens when the owner passes away? Will the remaining proceeds still be available to the heirs?
So yeah, actually, that's a great question. So what happens in the end, obviously, this is a loan where, since there isn't a payment being made, interest and mortgage insurance is accruing on the balance of the loan. So it's getting bigger over time. But at the time that the last person vacates the home, then we ask that you take, or you try to get the last, oh my goodness. Is that loud? Can you hear that?
No.
Okay,
I didn't
good.
hear anything.
Okay. The time the last person vacates the home, you get the statement, the last statement that was received has the outstanding balance that gets paid off through the sale. And then whatever is left would go to the heirs based off of how a trust would read. And we always say, please make sure that there's a trust in place when any transaction that, you know, has anything to do with your home, because that's going to be the vehicle to get the home to the heirs and be able to do what they need to do with it.
So the heirs also have the option of purchasing the home, correct? I mean, it's my understanding there are 4 options when the heir dies. They can sell it, right, for proceeds. They could buy it if they wanted to. They could short sale it, or they could let it go back to the bank.
Do a deed in lieu of.
Right. Is that
Yes.
correct?
Yes.
And all that is
Des,
correct. Yeah.
I'm going to let you do this. I have to turn off my little, it's very loud in here. One moment.
Okay. So can you hear me now?
Yes.
Good. And you're right about those options. And it's a good listing. So sometimes people shy away from it. If the last borrower has passed away or moved out, that's a good listing, and take the listing. And even if it's upside down, FHA is going to pay the loss. And it's like a predefined short sale. So you're not going to go through all that lumpiness that you went through with, 2008 stuff. Some of you weren't in the business in 2008, but lots of fun along the way there. But this one's a good one. Take that listing. So that was Liz, and this is FHA equals HECM. So it's a brief test here. And we're saying, in this case, see if I can do this so I can see my own screen. So FHA equals HECM, home equity conversion mortgage. Major benefit that we talk about. No required monthly payment, got to be age 62. So this is the quiz for what Liz just did. What the borrower has to do is TIMP, T-I-M-P. They got to pay taxes. And if taxes is T, I must be insurance, too easy to guess. M, maintenance, and as Liz was pointing out, normal maintenance. If the roof leaks, fix it, just that kind of thing, not Taj Mahal. Has to be a primary residence. And let's think about some of the things that we're trying to solve for with the client. Call that CAT, C-A-T. We're trying to improve cash flow. And a lot of times that's the primary thing that we're focused on, but there's also other things like asset preservation. And T again is taxes, but now we're talking about income taxes. What can we do to minimize income taxes for that client? So we got to start with what we call the traditional HECM. And this is the client staying in the home, and you're the center of the universe for your client's real estate needs. So they come to you for advice and direction. And they say, hey, I'm thinking about listing the house. And in the conversation, you go, you know what, that might not be the best thing right now for you. Maybe take a look at a reverse mortgage. So in our industry, this is still 83% of what goes on. And in our illustration, we're going to say the client's 72 and the value of the home is 600,000. So any of the numbers I use for housing values and stuff, don't worry about that. It's the concept. We know every market's different. But in this case, the client has a $100,000 loan that's been on the house for years, and they've been paying it down. And it's down to 100,000, it's $1,500 a month. And they're saying, well, we'd like to retire, but this $1,500 a month is kind of an issue. So you put in the value of the home, current interest rate, borrower's birth dates, and the computer says, I'm going to give you a loan amount. And in my example, it's 240. So here's the thing. It's like the older the client, the higher the LTV. The higher the rate, the lower the LTV. So you have these oddball things that happen with the reverse. And the thing we talk about reverse is that we can't make something complex easy. but we can make something complex like reverse mortgages understandable. And Marguerite talked about, the client's done the loan, it's done benefits for them, but they didn't understand every nuance. And that's what we strive for with the counseling and meeting with the clients. But at the same time, just be aware there are some nuances to the loan. So the loan amount's $240. The first thing that has to happen, we got to pay off the existing loan. So that $100,000 loan's paid off, $1,500 payment goes away. Life is better, cash flows improve. That also means we still have $140,000 left over and available. Now, when you talk to financial advisors, they talk about the clients in retirement. There's three major categories. There's the go-go years, there's the slow-go years, and there's the no-go years. And our clients are in the go-go years, right? They got hair color like mine. They want to do stuff. And they say, hey, could we get $500 a month coming our way off of this loan, a payout of $500 a month? We say, sure. So we put that down. We plug it into the computer, and the computer says to have the money available, we have to set aside funds. In my example, it's setting aside $80,000 because of their life expectancy. And it says we now still have $60,000 left over as a line of credit. And that line of credit can be used for things like, well, later on the roof leaks, fix it, the car blows up, get another one, that kind of thing. Now, this monthly payout, this 10-year payout, 10-year in our language is basically for life. So husband and wife, if you can see my fingers on the screen, they're both 72, they get the loan, and us guys, our warranty goes out earlier. He passes away. She's still on the loan and on title, and as long as she pays the taxes, insurance, does the maintenance at the primary residence, this money keeps coming. And if she lives to be 110, this money keeps coming. So the cool part about this, with that FHA insurance, it allows this loan to continue as long as she's utilizing the loan and just doing the four major things. Kind of a cool thing. In that one, there was no listing, and I get that. Not immediately, there would be one later, but whatever you did in Vegas will stay in Vegas. It's your chance to go to heaven because you gave them great advice, okay? So, well, let's talk about one that's, say, a little bit more current, showing up a lot now, downsizing. So we're going to make the client 72 years old. The home value is $1,100,000. Now, in our language, we have this concept called max claim limit. FHA says nationally, the maximum value they'll consider is $1,089,300, which proves it's a government program because that's an oddball number, right? But what they're saying is we'll lend, in this case, for the property values of $1,000,001, we'll lend a percentage of the $1,089,300. And if the property is worth, $1.5 million, same thing. Okay, got it. Now, this client also has some other things. They've got an IRA of $500,000. They've got other assets over here of $100,000. Not so liquid, it's like their Elvis Velveteen picture collection, that kind of stuff, right? But it's still their assets, and they are earning $120,000 a year to support the current lifestyle. Now, the value of the home's $1.1 million. They owe $600,000, and the monthly payment is $3,000 a month. And they're saying, yes, the goal is to retire. And so as they're looking at this thing, they're going, what can we do? So we look at, could we do a reverse mortgage? Now, one of the things I want you to note here over on the home value and the balance of the loan, there's $500,000 in equity in the home. There's another $500,000 in the IRA. There's another $100,000 in other assets. If they don't have much debt, this is a millionaire on paper. And so the point is, sometimes high net worth people should really take a look at this option. And we'll go through it and let's see. So we put their information in the computer, and we're going to solve for the goal to improve cash flow and retire. So the computer says, excuse me, I can do a loan amount of $440,000, which means I'm short $160,000 of covering this loan. Now they have options. One, they could go tap their IRA, pull out money, bring it to the loan with the loan and pay off the existing loan. But that triggers a taxable event. They got to pay income taxes. It reduces their money for retirement. And in the conversation, Marguerite finds out they're really not that interested in the home anymore. This is not their long-term home because it was a great place to raise the kids, but it's too much house, as Liz pointed out, too much maintenance, too much utilities, more room than they need. Let's put them in the right size home. Let's list this house. So in the listing we list and sell for $1.1 million, and we're going to net $445,000 after we pay off the existing loan, pay for services. And now let's go find the replacement home. In our area, you can find something for $600,000. It's a pretty nice house. So we're going to say they go out, they buy their replacement house. It costs $600,000. And we're going to use the reverse mortgage for purchase, R for P in our language, of $240,000 plus the down payment of $360,000. And they buy the house and they have no monthly payment. Yay. We improved cash flow. We eliminated that $3,000 a month payment. But in the process, out of the $445,000 that was net from sale, we only used $360,000. There was $85,000 left over, and we could combine that with their IRA to actually improve their retirement funds significantly. So what did we do? We got them out of the house that was too big. We put them into a house that's the right size. We eliminated the monthly payment, improving cash flow. We preserved assets because we didn't touch that IRA, and we didn't trigger a taxable event. And you listed and sold $1.7 million in real estate. Let's go look for these folks. Now, these retirement communities, what we want to do is find the people before they go to the retirement community. Once they get there, they're set, right? So let's do a little marketing and farming, and I'm just picking a zip. You pick your area you're going to market. Now, the first thing I do is say, look at your past clients. Do they have my hair color? Did you help them get into a big house? Is their loan probably paid down? There's somebody that knows, loves, and trusts you. First place to go. And then you say, well, let's go farm a little bit. So you can use REI Source, List Source, Title Pro, those kind of programs with your title companies, and create a list. And it's not a bunch of cost either. So let's put in their criteria. We're going to use a value of $600,000 to $2 million. Now, this was an area where I did a presentation a few months ago. That was the demographics of the area and the dollar amounts. And so we've got that. Let's say equity. We need an equity position, and we're saying 20 to 50%. Now, you might say 20% is not much. Well, 20% of 2 million is 400,000. There are things we can do. So we're also going to plug in, and this is the beauty of those programs, age. So you can laser, point to the age group we're shooting for. And you might put in another filter like 2-story. 2-story is my story. You have a good knee and you have a bum knee. That's the way life is. One day your good knee is also a bum knee, and all your bedrooms are upstairs, and you're going, up, time to get into that single-story home. So you've got your list, you mail out, your message might be something like, is your mortgage payment standing between you and a great retirement? We should talk. And then you start dripping them. So good way to get going for those downside scenarios. So if you think back, we had this ugly thing called pandemic. And what people said is, you can't go places. You should walk your neighborhood. So you start walking your neighborhood, and you walk. And it turns out that down the street is a house you kind of like. Now, they did an industry survey years ago and another one recently, and they said, if you're retired, are you going to move? And 37% of the people said, yes, I'm going to move. Now they said, what percent are you going to move up? And usually when we ask, what percent do you think of the 37%, what percent are going to move up? The guess is usually 0 to 10%. But it turns out it's 47% of the 7% are almost 1 in 5 are going to move up. You say, that doesn't make any sense. Well, it doesn't until you look at it from the perspective. My mom's 96. She lives in Tucson. She lives in her own house. She's independent, and she's depression era. Now, for her, the idea she has to have a house. It has a nice roof, floors are good. It's a house. It does what she wants to do. But as baby boomers, we don't want a house. We want the house. And as we're walking the neighborhoods, we go down 5 blocks, turn right, 7th house on the right. That's the house we want. And it turns out that house is coming on the market because you get to know the owners as you're walking, you chit chat. And you say, well, if they're going to sell, we want to buy. Well, our house is worth 500,000. We also have an IRA of 500,000, and we don't owe anything. We don't have a monthly payment. We've paid our house off. Again, a high net worth client. So let's list their house, and we're going to net like 475,000. And now we're going to go buy that house around the corner that they really, really want, and it's going for 750. Now, in our example, we say plug in the information, the reverse for purchase is 300,000. That means we need 450,000 for a down payment and our principal and interest payment. And our 450 came from our net of sale. And we don't have a monthly payment. So we put them in the dream home, coming from no monthly payment to no monthly payment. Now they know their taxes and insurance are going to go up some, but this is the dream home. So what happened was we, out of the 475 from the net of sale, we used 450. We put them where they wanted to be, and they had 25,000 left over to add to their IRA, and they actually have additional assets for retirement. So it's a pretty awesome scenario. But let's go market for those guys. Again, if you're going to farm for them, you start with your own people, but then farming, you go zip code, value. We're looking at the lower end homes in an area for people that might want to move up. So in our case, we said 350 to 600,000, you would decide. And then equity position, it has to be a really solid equity position, like 80 to 100%, because we need a lot of cash to go get the dream home. And again, we're using age 62 to 99 because we're going to laser target the age group. And so now we go out and we say, the DRIP campaign could say, have you wanted to purchase your dream home, but we're concerned it would create a large monthly payment? We should talk. And then you DRIP. So kind of a good one. Now, this one is one that Liz experienced, and she's going to let me tell the story anyhow. So the client came from San Diego. They sold their house and they had 900,000 net, happy campers. And they wanted to come and buy a house in El Dorado Hills. And so that's great. They come, they going to initially thought, well, let's buy the house cash for 750,000. And then we're going to have no monthly payment. Life is good. And we're going to have 150,000 in reserves left over. But part of the conversation that Liz has with the client, she discovered, one, they're more sophisticated than most clients. They'll deal with a little complexity. They also want to leave money for the heirs. And so having, money to bequeath their heirs was a big deal. So they start talking, and it turns out there's another solution. So they're going to buy the house for 750, but they're going to use the reverse mortgage for purchase. And at the time, with the interest rates where they were and such, the reverse for purchase loan amount was 375. That meant the down payment had to be 375, and they would have no monthly payment. So they would have the same monthly payment as if they bought the house cash, right? No monthly payment, but they had 900,000 that they started with, and they used 375 to buy the house with the reverse purchase, which meant they had 525 left over. And now they're ready to go shop. So they went and bought a rental property cash for 400,000. And the rents on that were 2,000 a month. And so what that meant was, hey, we used 400,000 of our 525,000 that was left over. We still have reserves of 125,000. Now, what's interesting about this is, like Liz has pointed out, so, here's the value of the home. If you can see my hands, here's the loan amount when they started. Now, over time, you have interest and mortgage insurance accruing on the loan. If you're not making a payment on the loan, it has to go somewhere. So the loan's getting bigger over time. Presumably property values are too, but what happens, right? Could go upside down. At this point, it's like, that would be what would happen on the reverse, but they transferred a bunch of their equity over to this rental property. And generally speaking, over time, what do property values do? They go up. And also, over time, generally speaking, what do rents do? They go up. And in this case, they not only move some asset over that was growing for their heirs, but they also had a cash flow that was inflation adjusting. So they kind of created a hedge for inflation in their decision too. And as we said, it's one of those things, not every borrower by any means is going to be this sophisticated, but this is what you find out when you have good conversations with them. So what did it do? It improved their cash flow, it preserved assets, and they might have a tax benefit because they've got rental properties. So pretty cool. Now, Liz talked a little bit about, some of the things that we have available. We're talking about the FHA HECM loan, and I don't have a slide in here for what we call proprietary loan. That's non-FHA loans, but verbally, real quick, what the benefit of those is larger loan amounts, larger property values. So loan amounts could go to like 4 million, property values 10 million and above, and they'll go to age 55. Now there's some things in those that are, not available on the FHA for like condo properties. Sometimes there's an advantage. So there's other things we can look at. There's even now a second mortgage that is available that would go behind the client's really low interest rate first mortgage. So a second mortgage, reverse mortgage that has no required monthly payment, and they can access money. So Liz will be a good source for other information on those particular loans, but just know they're out there. And if if the area you work has large property values, then that you might have a scenario where that might be the solution. Okay, so years ago, I had a broker friend that said, I need you to go talk to this guy. Now, this guy is 64 years old, and I talked to him a little bit, and he goes, I'm not the problem, but let me describe the situation. My mom is 86. She lives across town. And twice a day, I check on her. Is she doing okay? Is she taking her meds? That kind of thing. And this is my Friday. I go over to her house, do yard work, laundry, housework, pay bills, which means I stay over Friday night. I'm there Saturday morning, get all that stuff done, go live my life for Saturday afternoon, and repeat. So lather, rinse, repeat. And he goes, I love my mom, but this is a lot of stuff going on. And we said, well, let's just look for solutions. So one of the things we found out, the value of his home was $350,000, and he had no monthly payment. Likewise, mom's property was worth $350,000 and had no monthly payment at the time. So he said, well, are you in love with your house? He goes, I'm not married to my house. It's okay. Okay, let's look for solutions. So we're going to list his house, and we're going to net $325,000. And now we're going to go look for options. One option is the big house. So let's go buy the big house and let's move mom in, and that's her room. And then let's move you in, and here's your room. And he's going, no, under the same roof, my mom and I, there's going to be either pillow therapy, a homicide, there's going to be police involved. So we can't do that. Okay. So let's not do that. But at the time, what was interesting, what comes on the market but a fourplex? And at the time, it was going for $650,000. And we looked at buying it with the reverse mortgage for purchase, and the loan amount at the time was going to be $325,000. And we said, well, that means we need $325,000 for the down payment, which was going to come from the sale of his home. And we buy the house, the fourplex, and have no monthly payment. So we're coming from no monthly payment to the new house with no monthly payment. And let's move him in. This is his unit. And then we're going to move mom in, and here's her unit. So now the commute to check on mom is going to be 4 steps, right? And this wall is going to be bulletproof. We're going to get along. Okay. So we have a couple of units left over. And at the time, those were going for $750 a piece. So we got rents of $1,500 a month off the new house. Now, he was setting aside, he said, look, she's getting a little more frail. So we're going to set aside $1,000 a month for part-time, occasional come in the house care. So we put that in the equation. Now we sold his house, but they decided to keep her house. And that would rent for $1,500 a month also. So $1,500 plus $1,500 in rents minus $1,000 for care. We ended up with $2,000 a month positive cash flow. So the point is, where did we start? We started with $700,000 of real estate in the estate. We ended up with $1 million of real estate in the estate, $2,000 a month positive cash flow, a 4-step commute, a protective wall, and maybe some tax benefits because we have rentals. So it's a unique situation, and why we named the slide, each client is unique. Once we sat with the client, we found out this is a great opportunity for them, a way to solve a problem. You can't market this. You can't send out postcards saying, hey, is your mom 86? Does she live across town? Is her health kind of failing? No. But when you sit and talk to the client, you ask questions and you listen, you go, oh, we might have a great solution. So just keep it in mind, this reverse mortgage can be a great solution for a lot of people. And then again, if you have questions, ask Liz. Now, can I do a bonus thing real quick, Marguerite?
Absolutely. We have a few more minutes.
All right. So here's the thing is, I've been, Liz goes to bunches of real estate events and I go to several myself. And one of the things I noticed as a theme is people said, well, I was talking to the client, it would be a good idea for them to list their house, but they have a 3% fixed rate mortgage and they don't want to leave that. Have you run into that at all? Maybe kind of. So let's say you did. Let's just pretend I'm right. Okay. So here's the thing is, I think I'm going to write on this screen a little bit. So what they have is low rate. So 3%, low LR is low rate. I think what we want to do is go from low rate. And what's the benefit of a low rate? Low payment.
Low payment.
Yep. So we want to get them off of low rate because there aren't rates like that around anymore, but it doesn't matter. You say that rate is really beneficial to you, isn't it? Yes. Because it gives you a low payment, doesn't it? Yes. What if I could show you a way to list your home and get into the right home for you? And you had no payment. Could we have that conversation? So the idea is that we get the client from their fixation on low rate to talk about low payment, to then talk about the possibility of no payment, because now you know about this program that could be helpful to certain people in certain demographics, certainly not everybody. Somewhere between 18 and 20% of the population is age group appropriate. So kind of a good thing. That really is all that I have, Marguerite, I promise. And you can, if you got questions, Liz will help you out with that and stuff. And in the meantime, I really do appreciate you letting us come in and talk about the program because it's not widely known. And now you're in the top 3% of the people in the industry knowing a little bit more about what's going on with this program. So thank you.
Thank you so much for joining us today. This has been fantastic, and thought I'd give a couple minutes to see if anyone has any questions they wanted to ask. We did have a couple that were posted in the chat.
Oh, hold on.
One of the questions was, can heirs also attend the counseling session with their parent? Okay, that's a good one.
Absolutely. We recommend, I always like somebody else other than just the client sitting with their parent, with anybody that can help them make a good financial decision. Also, like a financial planner, a good friend, a neighbor, their kids. We want, as many people that can help them go through the process of asking the questions, because sometimes they don't know what to ask, or they just, there's some questions that are missed, but we really, really try to go over in detail everything. But anybody can be part of counseling except a loan officer. We can't even tell them what counseling agency to go to. By law, we have to give them at least 9. They have to choose. We don't even know who's good or bad because they are a third-party entity. We just give them a list and they go on and schedule it on their own.
Awesome. Great question. So I had asked the question, what if there's an age difference? Example, my husband is 70, I'm 59.
So yeah, you can do that. At least one person has to be 62. You would be a non-borrowing spouse. And what that means, which probably is, you're not going to like this, because the older you are, the more funds you receive. But in this case, we would have to calculate the loan amount based off of your age.
Okay.
So wouldn't get as much funds because you're younger.
Because I'm gonna, well, that's a good thing, I think.
It's a good thing.
Now Liz says that, but it still works. And
Yeah.
so as an aside, you're not old enough to do a FHA one yourself, Marguerite, but yeah, between the two of you, you can obviously. And I have a reverse. And initially when I did it with eligible non-borrowing spouse to get all the benefits in place. And then a couple of years ago, ended up refinancing it when my spouse was 62. And so it can be done. You just want to go in with your eyes open. And there are some things about that you'd have a conversation like with Liz about what are the advantages and are there some disadvantages? So
Yeah, and that would be something to think about, because I'll just make this quick. So for example, Marguerite, if you did it on your home and you did it before you were age 62, and let's just say you were going to receive proceeds on a monthly. Once Joe was not here, when he's not here, if he's not here, that benefit would stop because you weren't of age when you did it. So there are some setbacks or some things that you should just be aware of when you are not of age. So
And the age is 62, right? So I got a couple more
Correct.
years.
Yeah. Correct. Yeah.
Cool.
Good question. Good question.
Okay, let's see the other questions. We just had a question about is this been recorded? And yes, it has been. You guys will want to subscribe to my YouTube channel, and I've posted the link in the chat. And then that way you'll get recordings of all of them that are up there. So Alicia, you had a question? You raised your hand.
This might be more of a question for you, Marguerite, but what would it look like if they have a house to sell? Would it have to, close before and get those proceeds before we could start looking at the new house?
Yeah, it would be a concurrent closing typically. So we would sell their home and buy another, right, Liz?
So there, with the purchase, there is no concurrent closing, but you can get it. If, let's just say you have somebody who is selling their home, they're in contract to sell it. We would want to see a contract, and here's what we ask before closing. We want at least a week's time in between the close of one to get the proceeds to the sale of the other. So in that case, there would probably be possibly a rent back, or if they could stay somewhere for a week. So unfortunately, there's not an exact concurrent closing on this product when you close, but there are other things that you can do. But yep, something like that would work.
yeah.
Great question, Alicia.
Can I add one more thing? And then, it is a funky loan in some respects, and that's one of the things. But I'll tell you what, I had a client do. They went into contract and they had a house that was trailing, and that one wasn't selling immediately, but they had a bunch of investments that weren't doing so well in their retirement stuff. And so they ended up selling the losers on their investments and using that as the down payment. And then they bought the new house. And then after they bought the new house, they did a reverse and got funds back out, had no monthly payment, and were able to use those funds to buy better investments. So not only did they get into the house, they found a way to get in, but it was a little bit of genius because they had tax write-offs for the losses on their investments, and they upgraded their portfolio with the money after the fact. So it's kind of an interesting thing. There are things that you can do, and then you can help guide a client through, having to have a few days between the sale and the purchase. It's just a matter of writing the contract. So
Great
So Mitzi,
information.
and
then
Mitzi, it's asking what states we're licensed in. So we are licensed, we have licensees in all of the states except one does, and I can't remember which one that is.
New York.
Okay. I knew there
Yeah.
was one. Yes.
Yeah, New York's a tough state. It takes a long time to get your licenses.
Any other questions?
I think that's it. So thank you guys so much. This was awesome. We had a great turnout today, and thrilled to have you both here. And we thank you all for this information. So we really
Thank you,
appreciate
Marguerite.
taking
Thank
the
you for
time out of
having
your
us.
schedule.
Thank
And
you to
keep in mind,
everybody.
you guys, we do Tuesday tune-ups every Tuesday at 9 a.m. you're going to want to add your name to my list, head on over to margueritecrespillo.com. And you can also subscribe to my YouTube channel. So thanks so much, everybody. Have an amazing day. Appreciate your time.
Have a great day,
Bye-bye,
everyone.
guys.
Here, Marguerite.